Unless you live under a rock, you have 99.9% chance of having heard the term compound growth. Now, depending on your level of financial knowledge, there's a slightly smaller chance that you know that it has to do with investing and growing your money over time. But did you know that you can utilize compound growth to double your investments every 7 years without adding an extra penny? I'm explaining exactly how you can do just that, starting today. This is Rich Girl's Guide, where we demystify the world of personal finance to help you create a financially successful and fulfilling life. I'm your host, Kirby, and I worked in wealth management for over 6 years before leaving the office to focus on my business and my family. While compound growth can sometimes come off as an elusive concept, an idea that your money will grow over time, but you aren't exactly sure how it works or how much it will grow, there is actual historical data to back up these claims, and we can use our handy-dandy financial calculators along with historical data to get a fairly decent estimate of just how much our investments will grow over a certain period of time. Let's start with backing into the math of doubling our investments every 7 years. We are going to start with $100 in a Roth IRA because why not? If you deposit $100 in year 0, purchase all $100 into an index fund that averages a 10% annual return, and reinvest the dividends, then at the end of year 7, you will have $194.87. While it is about $5 short of truly doubling, you can easily surpass that by choosing an investment option that has a slightly higher annual return. For example, if you choose a fund that historically returns 11% annually, then you will have a little over $207 by the end of year 7. While that might sound great in theory, you might be wondering how exactly you can pick an accurate annual return figure. Fear not, let's do some investment digging right now. I'm just going to pick a super popular, great introductory mutual fund, Schwab S&P 500 Index Fund. We are going to type in the fund name to Google. Find the Morningstar page. Morningstar is a website that has in-depth, reliable information for all kinds of investments. And find the historical return information for this fund. Okay, so we can see returns for each individual year from 2014 to 2023. And year to date, the return is 15.73%. But what I am actually looking for is a 10-year return figure because that will give us a more accurate representation of what we can expect over time. Okay, I clicked on performance, and here we have a wonderful chart that gives us the 10-year average return as well as the 15-year average. Both of these are stellar. The 10-year average return is 12.84%, and the 15-year average is 14.78%. Now, being a bit more on the cautious side, I am going to use the 12.84% figure just because I would rather be pleasantly surprised with a higher return than be disappointed with a lower return in reality. So let's pretend that I'm going to purchase my $100 into the Schwab S&P 500 Index Fund in year 0. If I do indeed get the average annual return of 12.84%, then I can expect to have an ending balance of $233 at the end of year 7. Now, obviously, you are probably going to have more than one investment across your retirement accounts and investment accounts, but you can use that same logic to predict how much your accounts will collectively grow over time. If you want a more in-depth explanation, you can check out my episode Stock Market 101 that goes over different types of investments, where to find annual returns, and general stock market information. Real quick, I just want to pop in and say thank you so much for listening to today's episode. If you haven't already, please consider rating and reviewing this podcast wherever you are listening right now. This show is completely self-funded, and every review helps more listeners find the show, which ultimately helps me produce more content for you. Thanks so much, and let's get back to the show. While this might sound all good and dandy, you might be wondering how exactly compound growth works. Like, yes, I love that it doubles every 7 years, but how exactly? Without getting too much in the weeds, investments, stocks, and mutual funds will give you, the investor, dividends. Think of them as little gifts sprinkled into your account throughout the year. a few dollars here, a few dollars there, and they can build up as cash inside of your account. The more shares of a fund that you own, the more dividends you will receive. Let's say, for example, you will receive 50 cents per every share of mutual fund A that you own. You start out with 10 shares of mutual fund A, which means you will receive $5 in dividends into your account. Now, you have two options as to what you can do with those dividends. You can either leave them in cash and let the cash build up over time, or you can reinvest the dividends. Dividend reinvestment just means that you are using that cash to automatically buy more shares of mutual fund A. In doing so, you are now going to have more shares than your original 10 shares, meaning you are going to receive more dividends the next time dividends are deposited. Let's say mutual fund A costs $5 a share. If you receive $5 worth of dividends and choose to reinvest them, aka buy more of mutual fund A, that means you can purchase one extra share. You now have 11 shares of mutual fund A, and the next time you receive dividends, you will actually receive $5.50. 50 cents times 11. If you reinvest that $5.50, you'll be able to purchase 1.1 share of mutual fund A, giving you a total of 12.1 shares of mutual fund A. And I think you can start to see how your account is starting to grow the more that you reinvest those dividends. The more shares you own, the more dividends you will receive. Now, you might be thinking to yourself right now, Kirby, if you could reliably anticipate an annual return of 10% every single year, year over year, why doesn't everyone double their money every 7 years? That, my friend, is a great question with a bit of a nuanced answer. Some people are not comfortable with riskier investments that can reap the double-digit returns. They might be more comfortable with CDs or money market funds that are currently returning closer to 4 or 5% annually. And as long as those individuals are planning accordingly, meaning they are accurately estimating how much their investments will grow and are actively putting enough money away into those investments, then honestly, there's nothing wrong with that. Second, and bear with me here, not many people track their financial progress over time. So there are quite a few people who actually double their investments every 7 years without even realizing it. This is especially true for those of us who contribute every month or every paycheck into a 401k or investment account. We are most likely doubling our money every 3 to 4 years, especially in the beginning. But if we don't track our progress periodically, we might not realize it. Finally are the people that I lovingly refer to as flighty investors. These types of investors are constantly tracking their investment returns. They want those double-digit returns, but they cannot handle the months or even years when their investments have a negative return. These investors will typically veer towards individual stocks as opposed to mutual funds or ETFs. They tend to buy high and sell low. And as such, over time, they're going to have a lower annual return, which means it will take them longer to double their investments. Just in case I haven't already convinced you of the importance of compound growth, I'm going to go over an example of how compound growth works over time. Indulge me for a moment while we take a look at some actual numbers. If you contribute just $100 into your 401k when you are 20 years old and assume 10% annual growth, and you never add a penny more, you would have $7,289 by the time you are 65. That is $100 of contributions and $7,189 of earnings. And that is absolutely bananas. If you waited until you were 50 years old to contribute to your 401k, you would have to contribute $1,745 in order to get that same ending balance if you contributed just $100 when you were 20. Now, let's take into account the fact you will be contributing money into your 401k while also reaping the rewards of compound growth. If you contribute $100 every single month, from the age of 20 through age 65, and your investments are averaging 10% annually, then you will have a balance of $1,046,778 by the time you're 65. Now, of that, $54,000 will be your contributions. $100 every month, which comes to $1,200 annually, times 45, which leaves the remaining $992,778 as your earnings. Now, obviously, we are going to have up years where you make more than 10% annually, as well as down years where you will actually lose money and have a negative return. But as long as you don't freak out in those down years, because there will be down years, you are going to be setting yourself up for success by continuing to contribute to your investments, by reinvesting your dividends, and most importantly, not making any rash decisions when the going gets tough, aka selling out of your investments and leaving them in cash. Now, I want to know, have you noticed that your investments double every 7 years? Or have you experienced something different? Let me know down in the comments. Thank you so much for tuning into today's episode. If you have any money questions, please feel free to drop a comment on YouTube, email me at hello@richgirlsguidepodcast.com, or submit a question anonymously at the link in the description. I will catch you next Monday with a brand new episode. Till then, have a great week. Later, Rich Girls.